Good day, fellow investors. We continue with Seth Klarman's margin of safety summary, and we are already at chapter 3, as we do every Friday, and as we will do every Friday for the next 10-ish weeks, 11 weeks still to go. If you enjoy these summaries, smash that like button to support the channel, and let's start. We did speculators and unsuccessful investors, the nature of Wall Street works against you, and now we are at chapter 3, the institutional performance derby. The client is the loser. And why is the client the loser? We will just see from the ascendance of the institutional investors and the money management. This is insane. Just look at the numbers here. After World War II, increasing pools of retirement savings in corporate pension funds created an opportunity for professional money managers to go into business. Total funds under management rose from 107 billion in 1950 to more than 500 billion in 1968 and to 6 trillion in 1990 when the book was built. And US equity securities ownership from institutions increased from 8 to 45%. That is already something remarkable, but look at it now. Keep in mind 6 trillion in 1990. Now it is assets under management 112 trillion. That's an insane number. And look at the index institutional ownership, around 80%. Just index institutional ownership. So insane. Everybody's owning indexes, and this leads to the issues that we'll discuss in this chapter 3 and why we as clients are losers, and we have to be worried about that and avoid that. The first paragraph in chapter 3 is the money management business, and then Klarman discusses how the behavior of institutional investors is terrible because hundreds of billions of other people's hard-earned dollars are routinely whipped from investment to investment based on little or no in-depth research of analysis. Everything is efficient, and especially the fees are in the efficient market for them. The prevalent mentality is consensus, groupthink, so you must not do anything different than the others. You must just follow the crowd, be mediocre, and you will not lose your job. And the compensation is based on assets under management, not quality of work. The issue is that performance is constantly compared to the market. If you are like the market, it is okay. But if you are worse than the market, clients run away very, very fast. And then you think about, is it better to take risk of underperforming the market for a while to make more money, like Warren Buffett and Berkshire did, always underperforming, and then boom, boom, boom? If you do that, you can't leave Warren, you can just sell his stock. If you underperform as a money manager, clients run away, and this self-reinforces the issue with short-term performance compared to the market. So as a money manager, just do okay, do the average, don't shake the boat, and you will keep your job and you will keep your retirement account and everything. Just a great example for this video that we made on another great book, Richer, Wiser, Happier. So in that book, discussing Jean-Marie Avillard, 40 years for 12.5% was his performance value investing versus the S&P 500 of 9.35. Keep that in mind, 40 years doing great, but from 1997 till 2000, the Nasdaq was up 290%. He was just doing value investing, thus missing the boom there. He lost 70% of his clients, and the owners of the fund sold the fund with him in it. So it is a crazy story, but it works both ways, not just from the money management business, but also from the client business. It's very hard, if not impossible, to put the incentive of the management and the mind of the client in the same bubble of long-term investing and compounding that only Seth Klarman and Warren Buffett have succeeded in doing from the most famous people. And then discussing the short-term relative performance derby, when you compare yourself to the market, you are not making a sound investment. You are not comparing things to the fundamentals. Why do you always care about the market? Care about fundamentals, and as Seth Klarman says, the blame is both on the management and the client that jumps ships very, very fast. The second issue with Wall Street and money management is other people's money and your own money. Just read this. This is from Morningstar 2011. 45% of stock funds and 66% of bond funds that are considered core basic building blocks of a portfolio like an S&P 500 index have a grand total of zero management investment. Zero. So 45% of stock funds have zero management investment. That's crazy. And this is perhaps even crazier. 2017, 1,155 funds out of 7,424 had at least one manager with more than 1 million of her own money invested in the fund. So just what is this? 15% of fund managers. Oh no, this is not even 15% of fund managers. This is just funds that have one manager invested his own money into the fund. That is insane. And Klarman mentions how in ancient Roman times, this is where I went to school in Croatia, the Roman ark, the architect had to stand below when the scaffolding was removed, and if the ark then crashed, the architect would die. That's not the case on Wall Street, unfortunately, nowhere, because there is always a difference between managing your own money and other people's money. And then also now with YouTube and everything, there is a difference between managing your own money and how big that money is compared to the incentive of YouTube views and everything. So that's also something that one has to think about, but it is a distorted world, finance is. And then Buffett versus everybody else. Buffett put all his money in Berkshire. You can sell the stock, you can trade it, but you cannot pull out money from Berkshire. So he doesn't care what others do and does good. What others? Apart from the 40-year bull market. And then other issues too. Institutional investment, no time to research, you are busy increasing assets under management, clients, meetings, presentations, bureaucratic decision-making process. It's hard to sell something, reinvest, trade. The portfolio turnover is actually seen unfavorable by the SEC, using analysts' reports, not making their own research. So that's a hard world and difficult to also do it properly. And then greed and fear, yes, but in the comfort of consensus. And that also something to please the client, own things there. Then there is also portfolio size. More assets under management, more fees. Unfortunately, the truth is that the performance is lower. The more money you manage, the lower you will perform. There is also the incentive of being invested at all times, no matter what. And this is very important for value investing. Absolute performance-oriented investors will buy only when investments meet absolute standards of value. You don't care anything relative or something like that. You just invest when it fits you, and if not, you do simply this. In investing, there are times when the best thing to do is nothing at all. Another self-imposed constraint is overly narrow categorizations, bonds, emerging markets, high yield, growth, whatever. There is no flexibility. If you are a high yield manager, you say, okay, this is shit now, let's jump into something else. You lose your clients, and the assumption is that they are with you because they want to invest in stocks now, emerging markets. So there is an extremely narrow categorization, and sometimes you make money, sometimes you don't, and that's what also we discussed in chapter 2. Then we have another portfolio insurance issues and find formulas to invest, rebalancing things. And then there is a great example, what happened in 1987 when the stock market crashed 20% in a day. Pause this video so you can read this great paragraph. And That's also something, always these models, bonds and everything, and tactical asset allocation. Computer decides whether bonds are better than stocks and vice versa. Today we have alpha, beta factors, whatever, but this all works until it doesn't. Then again, on tactical asset allocation, you need to own bonds in a pension fund. You need to own 40% of your assets in bonds. But then you're forced to buy something like that. 100-year debt of Italy, that with higher interest rates now, if you invested 1,000, now you're likely probably already just a year and a half later, you're probably at 500 for just a loss of minus 50% as interest rates went up. But pension funds, our dear pension funds, own such shit investments. Now let's discuss something very interesting. Seth Klarman doesn't like index funds, hasn't liked index funds, and he has written about it 30 years ago, and he has been wrong for 30 years. That's value investing, but I think he still sticks to his mantra. Let's see. So wrong for 30 years, but the key core there as a value investor, that index funds don't care about the fundamentals nor the business. There are positives, of course, no fees, no transaction costs, but you will get average returns, and all is based on the efficient market hypothesis that works until it doesn't anymore. So the idea is that whatever you think you can't beat the market, Klarman and Buffett are the proof of that wrong. But as Klarman says, he's a believer that the market is not efficient, that you can do better. And as Warren Buffett wrote in 1988, in any sort of contest, financial, mental, or physical, it's an enormous advantage to have opponents who have been taught that it is useless to even try. I believe that over time, value investors will outperform the market, and that choosing to match it's both lazy and short-sighted. And here are the flaws of index funds. It becomes self-defeating when more and more investors adopt it. No analysis, no price movements, nothing, just buy as the market says. Replacing a position has an impact on the stock. So the S&P 500 index effect. I was owning this a year and a half ago. Then it got included, Fresh Del Monte Produce, in the small cap, and then it jumped 20% in a day. And that was because of the inclusion. Now, if you look at statistics of inclusion, you can see that there was a big effect in the first 5 years of the 1990s, a smaller effect in the 2000s, and then over the last 10 years, practically no effect for inclusion and exclusion for the S&P 500. What happened? Maybe liquidity, maybe not, but still very, very interesting to follow. This was the case when Klarman was writing. Maybe it will be the case again. We will see. Now, of course, some stocks are impacted. Tesla announced November 16, 2020, added December 20, and over that period it was up 44%. So it worked for Tesla to be included in the index. For others, statistically, it didn't work, but okay, maybe for the liquidity that is or has been over the last 10 years in the market. Another flaw of index funds is no voting. Huge problem, especially now, not just 10 years ago, because indexes not voting, passive, own the world. Vanguard, look at the stake in Apple and all other index funds except Berkshire Hathaway here. And then also something that happened and is still going on, the bull market gives wings to indexing, and Seth Klarman wrote that it will turn out to be just another street fad. When it passes, the prices of securities included in popular indexes will almost certainly decline relatively to those that have been excluded. More significantly, as Barron's has pointed out, a self-reinforcing feedback loop has been created where the success of indexing has bolstered the performance of the index itself, which in turn promotes more indexing. When the market trend reverses, matching the market will not seem so attractive, the selling will then adversely affect the performance of the indexers and further exacerbate the rush for the exits. We have not yet seen that, but it still holds likely because mindless investing will go mindless one way or the other. We have to keep in mind that we have been enjoying a 40-year bull market, and Vanguard has been founded in 1976, so it's a pretty new invention. Stocks have been going nothing but up, and that is something also to keep in mind, and we'll see if this trend will revert or not over the next 40 years. Likely not, in my opinion. There will always be indexing in some way, higher or lower, because that's now an integral part of the thing, but we'll see whether the benefits will be positive over the next 20 years or not. So the key here is to understand Wall Street, the incentives and everything, and don't fall into Wall Street's traps. Thanks for watching the next chapter, Delusions of Value, the myths and misconceptions of the junk bonds mania of the 1980s that we'll try to also modernize to the current period. Thanks for watching, smash that like button, and I'll see you in the next video.